Welcome back. Welcome back to another episode of Good Money Mondays on IMFGTV, where we bring practical financial literacy to practical people. I'm your host, Kelly T. Today, we're breaking down a question a lot of people are confused about. What's the difference between your FICO score and your credit score? If you've ever applied for a loan, a credit card, or even tried to buy a car, you've probably heard both terms, but they're not the same thing. Your credit score is a 3-digit number that represents your credit worthiness. Credit worthiness is just a way of saying the likelihood that you'll repay borrowed money. Can we trust you with lending you this money? Credit scores are calculated using information from your credit report, such as your payment history, amount of debt, length of credit history, types of credit, new credit inquiries. Different companies create different scoring models. So your credit score can vary depending on which model is being used. A FICO score is one specific type of credit score created by the Fair Isaac Corporation, also known as FICO. Over 90% of lenders use FICO scores to make credit decisions. It ranges from 300 to 850 based on the same categories: payment history, credit utilization, length of credit, credit mix of accounts, and new credit, but weighted in FICO's formula. So while credit score is the general category, FICO is the most widely used brand of credit score. Here's the key difference in simple terms. Think of it like this. Credit score is the general term, like saying sneakers. FICO score is a specific type of credit score, like saying Nike sneakers. You can have different credit scores depending on the scoring model, but your FICO score is the one most lenders care about. Why this matters to you. 1. Don't be surprised if you check your credit score online and it looks different from the one a bank or a lender pulls. 2. Always know your FICO score if you're preparing for a major purchase like a home or a car. 3. Work on the fundamentals. Pay bills on time. Can I say that again? Pay bills on time. Keep balances low, avoid unnecessary inquiries, and build a healthy credit history. Your FICO score and your credit score aren't enemies. They're just different tools used to measure the same thing, your financial trustworthiness. So focus less on the confusion and more on the actions that make both scores strong. If you got value from today's episode, hit that like button, subscribe to IMFGTV, and drop the word credit in the comments if you're serious about building yours the right way. This has been another episode of Good Money Mondays, where we bring practical financial literacy to practical people. See you next week on another episode of Good Money Mondays. And remember, it's Good Money Monday, Good Money Monday, Good Money Monday, Good Money Monday.